Okay, we're going to start the seminar now. Again, as you have questions, try to ask them, and if I'll either try to answer them as we go along, or maybe open up the mic. We'll see how that goes. I have yet to learn how to do a fake background, so you're actually seeing my messy office as we talk. I apologize for that. So again, we're just going to talk about some last-minute tax planning with your IRAs and also just generally Roth conversions. And my name is Mike Solomon, and I've been practicing a long time. I don't even like to think about how long I've been practicing. I have a background in tax and estate planning, also business law. And our firm, as you know, does a lot of estate planning and a lot of tax planning and business also. So with that in mind, we'll start the seminar. There we go. So we're going to talk first. We're going to break this up into two parts. There are contribution caps and how much you can contribute to an IRA, a Roth or a traditional IRA or a 401k. And there are deductibility rules. Those are two separate rules. So I'm first going to talk about the caps on how much you can contribute. So for 2020 and 2021, you can contribute up to $6,000 to a traditional IRA, plus an additional $1,000 if you're 50 or over. Same thing for a Roth IRA, if you have wages and self-employed earnings. So you also could contribute if your spouse has wages or self-employed earnings, even if you don't. So, but you have to have some wages or self-employed earnings, either you or your spouse, or you can't contribute. And then you can contribute up to that maximum. Next, a Roth IRA, same sort of rules, except to qualify for the full contribution for 2020, your income has to be within certain bounds. So for a single person, assuming you have some salary and some earnings, as long as your modified adjusted gross income, and I'll describe that in a moment, must be equal to or below $124,000 if you're single, to qualify for a full contribution to a Roth. If your modified adjusted gross income is greater than $139,000, then you can't contribute to a Roth IRA. And there's a phase out in between the 124 to 139. Those limits are slightly adjusted for 2021. So, if you know you're going to be in that realm and you want to make a contribution to a Roth, by the way, then you might want to consider doing both 2020s and 2021s right now. You don't have to wait. However, if you can't qualify for a Roth because your income is above that 139, there's a non-deductible IRA option, and then convert it to a Roth, and I'm going to discuss that in a few moments. Now, modified adjusted gross income is your adjusted gross income plus tax-exempt interest, plus some of your Social Security disability income if you're on that, and some foreign income, which I'm not going to get into. And adjusted gross income is your gross income less certain above-the-line deductions like IRA contribution. So that's approximately what modified adjusted gross income is. If you're close to the line, then you have to see, if these changes modify that in any way. But that's the definition of that. Now, I'll stop for a moment as people have questions. Feel free to go on the Q&A, and we'll be glad to try to answer your questions. Now, married couples have slightly different Roth IRA limits. So a married couple, if you're filing jointly, if your modified adjusted gross income is less than $196,000, you can contribute to a Roth completely up to the contribution limits. If your income is above 206, you can't, and then anything between is phased out, slightly modified in 2021. So again, you can contribute if you're married couple, each and your adjusted gross income is less than 196. The husband and wife can each contribute $6,000 plus that extra $1,000 if they're over 50. 401k, if you're still working, you can contribute up to $19,500 to a 401k plus an additional $6,500 if you're 50 and over. And that could be a Roth contribution or a deductible contribution, depending upon if the plan allows it. Now, again, it used to be and they just changed the law last year. You can make a contribution to a traditional IRA or a Roth IRA, even after age 70 and a half, if you have wages and self-employed earnings. Used to be you couldn't do that once you hit age 70 and a half, and now you can. More people are working past that age, so they're allowing that. So that was the contribution caps. Again, to recap, the contribution caps, It's, as I've mentioned on page, let me flip around here, $6,000 for a traditional IRA and an extra 1,000 if you're 50 or over. Same thing for a Roth IRA, and the 401k is 19,500 plus another 6,500 if you're 50 or over. So those are the contribution limits. Now we're going to talk about the deductibility caps, which are different. So if you're covered by a retirement plan at work, this is 2020 now. If you were covered by a retirement plan at work, a 401k or 403b or wherever you're working, a single person, you get the full deduction for your contribution, let's say of $6,000 to the IRA if your total adjusted gross income is less than $65,000. If your adjusted gross income is greater than $75,000 or 75 or more, then you get zero deduction. You can still contribute, but you get zero deduction. And there's a phase in between. If you're married filing jointly, the limits are slightly different. It's 104,000 or less. You can get a full deduction. And if you're 125 or 124,000 or more, zero deduction. And for 2021, it's increased. The adjusted gross income limits are increased by 1,000 to see if you fall in that. So again, besides doing 2020, if you're eligible and you have the cash, consider making the contributions now in the beginning of 2021, not only for 2020's contribution, but for 2021. So that way you start the money growing tax-free or tax-deferred early on. Now, if you're not covered by a retirement plan at work, but your spouse is, you can also get a full deduction if your modified adjusted gross income is 196,000 or less. Zero deduction if your modified adjusted gross income is above 206. So again, remember, if you don't have a retirement plan where you work or you're not working, but your spouse is working and is in a retirement plan, both of you can make deductions to the IRA if your income is below 196. And even though you have no income and your spouse has income, he or she can make that, you can make a contribution based on their income. So keep that in mind. Now, if neither of you are covered by a retirement plan, 401k or 403b, or just a regular profit sharing plan, there's no deduction limit. You can contribute the total amount up to the contribution limit of $6,000 to your IRA, and you qualify for the deduction. Again, if one spouse is working, the other isn't, you can set up a spousal IRA. So a husband and wife should be able to max out, if they have the cash, and get deductions for their entire IRA contributions. And again, something you should definitely consider. And again, there's no age limit anymore. Oops, did I flip around there? Excuse me, I went the wrong place. So deadlines, when do you have to do all this? April 15th. April 15th, I'm really messing this up. One more time, deadlines. There it is, April 15th. So if April 15th had fallen on a weekend, it would be different. You'd have till the next Monday. But this April 15th falls in the middle of the week. There are no extensions allowed. You have to contribute by April 15th for 2020. Used to be a number of years ago, they allowed you to file an extension and delay your IRA contribution if you wanted till the filing extension date, which was October. But now it's April 15th. More importantly, probably for many of you, is required minimum distributions are starting again in 2021. Excuse me one second. Gotta get my teeth. I apologize. Back in 2020, due to the COVID problems, they allowed people to defer their required minimum distributions in 2020. They didn't do that for 2021. So if you already were required to make required minimum distributions in a prior year, you have to begin again. Also, around a year ago, I think it was now 2019, I'm losing track of years, they changed the required minimum distribution rules. And if you were born on or after July 1 of 1949, you don't have to start taking anything out until you reach age 72. If you were born prior to that, then the old 70 and a half rule applies. Oops, I see I have a question, so let me see if I can get to that. See what that is. Okay, so it asked me to redefine adjusted gross income. So let me see if I can find it on the slide. But bottom line is modified. First of all, you get to adjusted gross income, and that is your gross income less certain deductions like IRAs. And let me see it. I'm just going to see if I can find it just so it give me the right slide. There it is. Okay, so first you get to adjusted gross income. You take your gross income that's at the top of the 1040, you subtract some above the line deductions like IRAs and maybe HSA accounts and things like that, and you get to adjusted gross income. Then modified adjusted gross income, which won't be on the tax return directly, is you take that amount and you add back tax exempt interest, Social Security disability income. I don't know why they do that, and certain foreign income. The big one would be tax exempt interest. So what they're trying to do is take away some of the benefits for the wealthier people, the people who have a higher income. So if you have a lot of tax exempt income, they're going to add that back into the calculation of your adjusted gross income, and that becomes the modified adjusted gross income. So let me move on. Okay, so I described the minimum required distribution rules. So that's very important, by the way. If you miss that rule, if you miss the deadline for taking those required minimum distributions out, the penalty, besides having to take that out and include it in income, there's a 50% penalty tax. So you have to have a very good reason to miss the deadline. And the IRS doesn't like to give those grants, but sometimes there were events like when there was a weather catastrophe that maybe means that people didn't have a chance to do it, something like that. But generally, it's very hard to get away with it. Just I forgot or I was busy. I don't think you're going to get an excuse for that. Sometimes there were times when a particular bank wanted a foreclosure and you couldn't get your money out in time, then you might get an exception. But generally, you got to make sure you hit that deadline. Now, fortunately, most banks and brokerage houses, if you tell them to do it, will calculate your required minimum distribution for you and make sure they take it out. But you need to make sure you do that, and it adds up all of your IRAs. So you need to make sure that you're getting them from each IRA, or you can pick one IRA to take the required minimum distribution from. You don't take a little bit from each one. You can pick on one, but make sure you do the math right, or you're going to have some big time penalties. Now, here is one that's something that people should consider, but it's a tough decision to make. As you know, a traditional IRA, when the money comes out, and it has to start coming out now under the new rule by age 72, when it does come out, it's all subject to income tax, assuming all your contributions were deductible when you put them in. And I'm going to use that example. I'm not going to get into the examples with non-deductible IRA contributions. I'm just going to assume that all of your IRAs right now contain contributions that were made with pre-tax dollars. You either got a deduction putting it in, or you rolled it over from your 401k plan and put it in a traditional IRA. So when you pull that money out, you're going to pay income taxes on it. If you pass away and you die, whoever inherits that IRA is going to pay income taxes on it. And then, under the new rules, which I'm not covering in detail here, when you pass away, except for certain exceptions, that IRA has to pay out over a 10-year window. And some of the exceptions would be paying out to a spouse who could roll it over, paying out to minor children, paying out to certain disabled children or disabled individuals, I should say. You can stretch out the IRA, but the old stretch-it IRAs have basically been eliminated. So beginning at age 72, a traditional IRA, you're going to start taking it out. And on your passing, it goes out in a 10-year window. Roth IRA grows income tax free. And then when it comes out, it's income tax free. While you're alive, you don't have any required minimum distribution date. So it can come out, you don't have to take it out at all. You can die holding that Roth IRA. And then on your death, it has the same payout rules, generally over 10 years. except with certain exceptions like spouse or a minor child, not a minor grandchild, but a minor child. Basically, they got rid of the stretch IRA, which was a tool we were using for a lot of clients, allow them to pass their IRAs, whether it's a Roth or a traditional, onto grandchildren and let those compound literally for decades. That rule is basically gone. So first of all, let me talk about what's called a backdoor Roth IRA. As I mentioned earlier, if your incomes are below or above certain amounts, you cannot make a contribution to your Roth. It's just disallowed. Now, there is no income limitation on non-deductible IRA contributions. Remember, the IRA, the contribution to a traditional IRA may be deductible or may not be deductible, depending on whether you're in a retirement plan or your spouse is in a retirement plan. Even if it's non-deductible because you're in a retirement plan or your spouse is in a retirement plan and your income's too high, you can still make it. It's just not deductible. It still grows tax deferred inside the non-deductible IRA. But then when you pull it out, you pay income tax on the growth. But what you can do is you make a contribution to this non-deductible IRA because your income is too high or your spouse's income is too high. You make a non-deductible contribution and you immediately convert it to a Roth. There's no restriction on that. So now it's a regular Roth IRA and it grows income tax free, all the growth. And rather than pay income tax on the non-deductible IRA as it grows. So that's something that people do a lot. Now you can convert an existing IRA, any IRA, or multiple IRAs to a Roth IRA. However, the rules get very complicated if you have pre and post-tax contributions. I'm not going to get into that. Or when you convert an IRA, you have to convert, if you convert an IRA, you may have to convert more than one IRA. Okay? So think about it, because I had that situation with a client where they had a small IRA and they had a rollover IRA from their employer, and to convert their non-deductible IRA to a Roth, they had to convert also their regular IRA. So you need to think about that. But look, if you have multiple IRAs that have both pre-tax and post-tax contributions. Okay, let me continue on. I'm sure I made that a little bit more complicated than it should be, but definitely consider converting your existing IRAs to a Roth. But certainly if you have a backdoor Roth, if you have a non-deductible IRA, you should convert it. Let me scroll down. Now, who should convert to a Roth? The pros of being a Roth, there's no minimum required distribution. It's income tax-free growth, and when it comes out, it's free of income tax. And then on your passing, the IRA can pay into, the Roth IRA can pay into a trust with no adverse income tax consequence. So let me explain what that means. Okay, let's say you have a retirement account. It's built up quite a large amount. You want it to pay to your children or your grandchildren, but you don't trust that they'll handle the money properly. Or you're worried they're going to have a creditor problem, or maybe they're going to get a divorce. So you don't want to give them the money directly. And also, you remember the money comes out, has to come out no later than 10 years. With a traditional IRA paying into a trust, the trouble is if that IRA, when the money comes out of the IRA, if it goes into the trust has a maximum income tax bracket of 37%. It hits the maximum bracket after approximately $13,000 of income. Or if you're an individual, you have to have an income of like $400,000 to $500,000 to hit the maximum federal income tax bracket. With trust, you hit it after approximately $13,000. So it's bad planning. If you have a traditional IRA pouring into a trust and it stays in the trust, you're going to give the government 37% of that money fairly quickly. So a lot of people don't want to do that. And I can understand it. But if you have a Roth IRA, even though it empties out into the trust in a 10-year period, there's no income tax. So there's no adverse income tax consequence. So let's say you have a $500,000 Roth IRA paying into a trust for the benefit of your grandchildren. After 10 years, you have to liquidate that Roth into the trust, but the trust will pay no income tax on that. Then the money is held in the trust for the benefit of your grandchild pursuant to the terms of the trust. So if you have a large retirement account that you want to pass on to children or grandchildren, but you're worried about their ability to handle the money, the Roth is the way to go, not a traditional IRA. The other thing, if you have a potential federal estate tax, right now the exemption is pretty high, 11.7 million, though it may be reduced this year depending on what happens in Congress. But if you have a large estate already, by converting from a traditional IRA to a Roth IRA, you're going to owe income taxes on all that money you convert. By paying that income tax, you've reduced your taxes, your estate tax liability down the road. That's actually good planning if you're in that situation. It's a limited group of people. Any questions on any of that? Okay, let me go on. Now, the disadvantage. Well, you pay immediate income tax when you convert from a Roth to a traditional IRA. Now, in the past, last year and prior years, they gave you some deferrals. You could pay the taxes over years. But now, right now, the law as it exists, you have to pay all the tax at once. There are also some adverse consequences to you in that you may end up paying more in your Medicaid premiums for that year because your income goes up. As you know, Medicare premiums are income-based. So your Medicare premiums will go up for a year. You're going to possibly pay more tax on your Social Security benefits for the same reason. And there's some phase outs of income tax deductions that may impact you. So these are short-term problems, but they'll happen. So you need to think about that. Okay, now there's another question. So let me try to answer that. Is there any minimum earned income required to do an IRA to an IRA Roth conversion? No, you can convert. You can convert your funds at no matter what your income. They don't have a problem with that. If that's your question, so you could have $1 million of income and you can convert your traditional IRA to a Roth. The IRS doesn't have a problem with that because they're collecting more taxes. Okay, so let me move on. Any other questions? Please feel free to ask. So who should consider converting to a Roth? Number one, you don't need to take money. If you don't need to take anything out of your IRA to live on, you're never going to take it out. The only reason you would have taken it out is because the IRS is forcing you to take it out. Then you should consider converting to a Roth. You have other funds that are not tax deferred to pay the income tax, because if you have to take money out of the IRA to pay the income tax, you ruin some of the effectiveness of that. And you anticipate that the beneficiaries of the Roth, the people who are going to inherit your Roth, are in a higher bracket than you, or at least the same bracket that you're in, or you're in a very low income tax bracket. By that, I mean, some people will convert year to year. They'll use up some low brackets. That maybe they're in a 15% bracket, and they'll take money out to use up the rest of their 15% bracket. You could do that, but if you're in a very low bracket, some people do that. But if the beneficiaries are going to be in the same bracket you are or higher, then you should consider doing that. There's another question, so let me take that. Okay, the person was clarifying. They say they have no earned income and they want to convert. Yes, you can convert to a Roth. Actually, you're better off because maybe your income is very low and it won't cost you as much in taxes. Okay, now who shouldn't consider converting to a Roth? Let me get to that. If you need the money, if you're going to need the money to live on, then you don't want to convert, because why pay all your income taxes now? You're giving the government money long before you have to. Then just take out the minimum distributions from a traditional IRA, pay your taxes as you pull the money out. I wouldn't take it all out. If you're uncertain, I don't know whether I need the money or not. Well, you can't undo this. So once you convert to a Roth, you've converted. Now, used to be you actually could unconvert. You convert, and then you had a period of time you could change your mind. They got rid of that a number of years ago, so you can't unconvert. So don't do this if you're going to need the money you think you might. The other reason you don't do it, you don't care what happens after you pass away. That's their issue. Then don't convert, because then you're holding off on taxes. Because the major benefit of this is for your heirs. And so I have some other questions here. Let me try to get to them. Let me see here. Doing a Roth IRA conversion will increase current taxable income and Medicare premiums. Is it Is that worth it to reduce the IRA balances and future RMDs? Well, that's a good question. I think if you want to pass something on to your children, free of income taxes, I think 1 year's hit on the premium is not that much. I mean, if it's an issue for you, if it's a significant issue, then you're not appropriate to convert. You're right, but the increase in premiums might be, and I'm making this up, I can't remember right now, might be $50 or $60 a month, 70. There's a table, I just don't remember what it is. So it's a short-term 1 year problem. In the long run, if you're trying to pass wealth on to your heirs at a beneficial rate, then I think it makes sense in most situations. There are other questions? Okay, so some timing issues. Now, there are some issues when you convert to a Roth. So when you convert to a Roth, you have to leave the money in that Roth for 5 years, including the year you convert, to avoid the 10% penalty if you remove the fund. So, for example, if I have a $100,000 traditional IRA and I convert this year, and next year I say, you know what, I'm going to take that money out. Now, you won't pay income tax on that $100,000. You already paid it this year. So this year I convert my traditional IRA, $100,000 to a Roth. I pay, income tax on $100,000. Next year I find I need the money, and I'm going to have to take that $100,000 out. I pay a 10% penalty on top of that. Okay, so bad thing. So you want to leave that money in for 10 years. For 5 years. After 5 years, you can remove that $100,000 out, and there's no penalty. Not the earnings yet, but you remove that $100,000, and you leave the earnings in there until you hit age 59 and a half. Then you can pull it all out income tax free. So to repeat that, when you convert, think about you're trapping that money for 5 years. You don't want to pull it out and pay a penalty tax. After you get past the 5 years, it's the normal rule. You know, you're all familiar with traditional IRAs. You can't take it out prior to age 59 and a half, with certain exceptions like buying a home for the first time or disability. There are exceptions like that. But generally, you have to wait to 59 and a half. So I'm over 59 and a half. I'm 69. If I convert my traditional IRA to a Roth, I still got to wait 5 years, because I got to wait 5 years or I'm going to pay that penalty. Once I get past my 5 years, I can take it all out income tax free. Let's say I'm 56. Well, let me give a better example. 52, I convert to a Roth. I got to wait till 57 or the 5th year. Let's say it's 50. I'm 57 at that point. Then I can, after the 5 years, I can pull the money out, but I'm still under 59 and a half. Now I'm going to pay a penalty tax there. Once I get to 50 on the earnings now. I'm way too complicated. Let me do that one more time. $100,000 IRA, accrued 120 over 5 years. I get past the 5 years, I take my 100 back. I can deem that the first dollar's coming out, and I'm fine, no penalty. That 20,000 of growth, I'm going to let sit in the Roth IRA until I get past age 59 and a half, and then I can pull it out income tax free. You can see there's a lot of planning that has to be involved. Now I see a bunch of questions, so let me see if I can answer some of them. Let's see. Okay, one of the questions, do you suggest waiting until tax time to pay the taxes or pay them at the time of conversion? Good question. So if you have, let's say 2021, I convert a $500,000 IRA to a Roth. I have $500,000 of income. You're going to have to satisfy the IRS rules on paying income taxes. You either have to pay quarterly to avoid the penalty tax of an estimated tax, or you have to satisfy certain safe harbors that you have paid enough taxes during the year compared to the prior year. So in 2021, if I convert a large IRA to a Roth, unless I paid a lot of income taxes the prior year, I'm going to at least have to make quarterly payments, or I'm going to owe an estimated tax penalty at the end of the year when I file my 2021 income tax return. So you don't have to pay all the taxes when you convert, but you have to pay it quarterly. Your accountant can help you with that, with quarterly payments. Let me see. So the next question is the tax charged regular income or capital gains? It's regular income. There's no capital gains on this. Okay, so I think that's all the questions. I'm going to give you some more time for questions, and let me mention a couple things. We do these seminars. We're trying to do them weekly. I should know, but I've forgotten already when the next one's coming up. We talk about different issues, and if you're on our email list, which you should be if you're attending this seminar, we'll email you our upcoming seminars and encourage you to attend. We also encourage you to sign up for a personal planning meeting with one of the attorneys, myself or Lori Steiner or Jennifer Peck. If you have any tax or estate planning questions you want answered, especially to go over any documents, estate planning documents you have, we charge a fixed fee for that initial consultation. If you say you came to the seminar, we charge you $275. If you haven't mentioned that, I'll be charging you $325, so mention it. That meeting is for the entire, that fee is for the entire meeting. So we go over your situation, come up with some recommendations, and then help you implement those recommendations, whether it's estate planning or tax planning. Be glad to help you with that. As an aside, our firm also does other matters, business and real estate. That's more my area also. So if you'd like to talk about those issues, please email us and or call us at the number that should be on the last, what's on the front page of the seminar outline. And give us a call, give me a call. I'll be glad to sit down and talk with you. We do Zoom meetings. We're going to be switching to Teams pretty soon to see how those work. And be glad to talk with you. We'll be sending you a copy of this outline shortly after the seminar today, if not today, by tomorrow. And I encourage you to come. And I'm going to try to answer any questions that are coming in right now, but that's the seminar. Thank you for attending. Let's see what we have here. The question is, how is the Roth 5-year waiting period monitored? Is the honor system, or does the broker, the IRS, monitor? It's more of the honor system. The broker, well, it's the honor system in a sense. When you take money out of your Roth, you are going to get a 1099. And then I guess if you don't fess up and say, and on the tax return, they're going to ask you when you contributed the money. And they'll ask you about the 5-year rule. I'm pretty sure they do that. And if you lie, you're committing perjury. So you really don't want to do that. So you're going to get a 1099 when you convert, and that kind of opens up the avenue for the IRS to figure out what's happening. So, and if you fill in on the form that it's within the 5 years, you use a software, to do your tax return, is going to make you pay the penalty tax. So you either have to lie, and then you could possibly be caught, which I don't recommend. So you follow the rules. It's better to wait. I'll again wait for some more questions. In the meantime, thank you for attending.